Inflation is the topic of an important lecture we held as part of the series in Advanced Political Economy in collaboration between the Free SOAS University in London and the New School for Social Research in New York City. Two professors joined the conversation, Professor Paulo dos Santos, who teaches economics at the New School for Social Research, and Professor Ramaa Vasudevan, who teaches at Colorado State University. Before we begin, I wanted to share a couple of thoughts. First of all, is that inflation really exposes at once the limits of our capitalist economy and its fragility. Why does it expose the limits? It exposes the limits because what we see is that there's clear constraint as to how much employment there can be in a capitalist economy without destabilizing money and pressuring higher inflation. So this is a big trade-off. Are we going to actually take care of the people by giving them jobs? Or are we going to take care of monetary stability, which is so structural to the functioning of exchange under capitalism? The other point is that inflation really showcases the fragility of the system. Why? Because inflation is never just an economic problem. It's always deeply a political problem. And this is something that even technocrats understand very well. I want to read you a quote from John Maynard Keynes, who's considered one of the most important economists of our time and very deeply engaged in technical issues. Yet he had to admit, in 1920, a continuance of inflation and high prices will not only depress the exchanges, but their effect on prices will strike at the whole basis of contract, of security, and the capitalist system generally. Why? Because inflation makes people angry. Because inflation exposes the deeply anti-democratic nature of how we access goods in a capitalist economy. How is it that my neighbor who has more money is able to purchase that bread that now I can't buy because I don't have enough money in my pocket, and the purchasing power of my wages has gone down because inflation has gone up? So inflation pisses people off in the real sense, and historically has been the reason for serious revolutionary surges in many places in the world. So this is the real point, is that when we talk about inflation, as both Paulo and Ramaa emphasize, there is no neutrality involved. There is no neutral approach. There is no good of the whole approach that can actually appease society in general. It is really about distributional conflicts and clear decisions of what takes priority. And what you see is that the way central banks have historically decided to deal with inflation by increasing interest rates takes a very clear decision of saying, well, we are going to bet on people's sacrifices, on increasing the unemployment rate so that we can bring down the cost of labor in order to supposedly solve inflation. Now, this solution, which is clearly a solution that we've seen under our eyes in the last years, is a solution that hurts people, but is also emblematic of how classist the analysis about inflation is in the first place. So a classist solution, having workers suffer, is derived from a classist analysis, which is the following. Inflation, they tell us, is ultimately the result of bad workers' behavior, in the sense that people are asking for wages that are too high and consuming too much. So this sounds absurd, but the two technical definitions of inflation that you hear around there, which are the definitions of demand pull, people consuming too much, and wage push, the very devastating wage price spiral, the idea that actually if wages go up, prices will continue to go up, set the blame on the workers. And this is a problem because, as many economists show us, inflation today can also be ascribed to exuberant and excessive profit margins. In fact, there is no deterministic moment by which, if wages go up, prices have to go up. The explicit decisions of corporations to increase prices so as to dump the cost of production on the consumers, so in order to avoid losing in their profits. So you see, this understanding of inflation that looks at profits rather than wages would have definitely different solutions in place for us, right? It would be about maybe capping prices, maybe having some public intervention, as Paulo says in his talk that we're just listening to about re-socializing certain basic goods in order for them not to be subject to the volatility and the price hikes of the market. Let's talk about it with the experts. I'm going to sit back, relax, and enjoy with you.
Inflation is a really tricky issue. And it's tricky in many ways. Even the way we think about inflation, well, there's many different ways in which we can even define it or think about it. We can take a very technocratic stance and define it as, the annual rate of increase in a particular aggregate measure of the price level, consumer price index or producer price index or whatever it is. We can think about it in a different way, perhaps more human way. And here I'm reminded of something that I saw 20 years ago at the Archway Co-op. It was late at night. I was still working on my PhD. And I went to the co-op to get some dinner. And there was an elderly lady, maybe in her early 80s. And this is before you had self-scan. So she took her basket of goods to the till. And even before the lady at the cash register gave her the total, she took out a 20-pound note to pay. I mean, clearly, she was expecting this to be either 20 pounds or less. And when the lady at the cashier at the till told her that it was 20 pounds 40 pence or whatever it was, I saw the look on the lady's face. She was taken aback, and she took a second before reaching into her pocket and taking the two 20 pence pieces to pay for the difference. And the point of that story is that we can and should also be thinking about inflation as a human thing. Here is somebody, a pensioner on a fixed income. And what inflation meant was an unexpected surprise. And in many cases, it will mean being unable to consume at the level that you've been accustomed to consuming over some time. That said, inflation can be something that on the aggregate is actually good for ordinary people in some settings. Certainly, inflation can be good for people who are indebted in situations where repayment with interest is not indexed to inflation. So you're dealing with something pretty complicated to start with. Making things even trickier is the fact that over the past, 3 to 4 years, we've been experiencing across the world a series of inflationary episodes that are different, that are a bit new. These are supply-side driven inflationary episodes that have been triggered by things like the production disruptions of COVID-19, the sequels of Russia's invasion of the Ukraine, the already discernible and measurable impacts of climate change on our productive capacities and productive systems. And in the case of Britain, whatever one's take towards Brexit is, we all need to recognize that created a series of shocks that are on the supply side of things and affect what happens to the cost of living in different ways. We also know that inflation has been politically consequential. I think that we are very justified to think, for example, of Trump's victory in the United States presidential election in 2024 to have been to a significant extent driven by a lot of resentment about inflation that was experienced during the Biden administration. What's interesting, of course, is that this has not been, at least as far as I can tell, kind of a rightward shift in response to inflation, and has been more of an anti-incumbent shift in response to inflation. And there's indication even here in the United States now after the elections last week that, again, anger about rising prices fueled now the backlash in the other direction against the Republican Party in the United States. So you're dealing with, when you're talking about inflation, you're talking about something that is sometimes difficult to define in a meaningful way, something that is clearly highly consequential, and to make matters even worse, something that is very complicated. Because as it turns out, there's different kinds of inflation, and economists don't even quite agree on that. And for any kind of inflation or inflationary episode that you may experience, there's never a single cause for that inflation. It is actually a very nuanced and multidimensional type of a macroeconomic thing. Now, whatever the particularities of any given inflationary episode, inflation always has class consequences. It means certain things for labor, and it means certain things for capital, and it means certain things for certain sections of labor and certain sections of capital. Inflation is a fundamentally political thing in a market economy. It is something that helps determine the economic outcomes of people. So we should not be surprised that in efforts to understand inflation and to put forward solutions or answers to inflation, we are walking into a deeply, deeply politicized and ideological terrain, where a lot of the conventional wisdom that conventional economics has put forward out there actually embodies a certain set of political biases and stances and an appetite to embed them into how we even think about inflation. And if today's talk and discussion does only one thing, I really hope that it is to shake your confidence in that story and to make you realize that this picture is complicated and that it is irreducibly political, although not without its economic constraints. Two myths, then, that I want to dispel right away. The notion that inflation is always and everywhere a monetary phenomenon, that if you want to understand inflation, all you have to do is think about how much money there is in the economy, the stocks of money, the monetary aggregates, so that if you want to control inflation, all you need to do is effect a monetary contraction of some sort. This is one of those zombie ideas that never goes away. And the other one that is perhaps more pertinent is the notion, the other zombie idea or thing I want to disabuse people of, is that the management of monetary systems and management of the aggregate price level is something that is technocratic, that you can somehow define something that is universally optimal for everybody, and that it's something that we ought to leave to experts, and that it is something that fundamentally involves really only one variable or set of variables, and this is interest rates. That the only thing that is relevant when we think about monetary management is a central bank's influence over interest rates. What I want to invite everybody to think is to think about this issue more broadly. We live in market economies. In a market economy, having money is having a measure of a kind of social power, right? You can go to the marketplace and you can appropriate goods from strangers who don't know you. You produce the money thing, and they give you stuff. It's this one very fascinating monetary social convention. By extension of that power that you have to mobilize goods and also to mobilize labor, because you can hire people with money in a market economy, is that there is a distinctive power then that is placed on the hands of those who are in a position to manage monetary systems, those who are in a position to create money, those who are in a position to act so as to influence the price level or the value of that money against labor and against goods, have a distinctive form of power. That in turn means power means a certain measure of discretion, which means that as we think about inflation, as we think about prices, we need to be thinking about the exercise of that power to manage the monetary system and the political choices that go into how that power is exercised. Monetary policy has at different points in history been used, for example, openly to boost employment, as has fiscal policy, right? Our aim is to reduce unemployment. In other instances, in fact, the Federal Reserve has a nominally dual mandate that tells it to be mindful of the level of employment. At different points in history, one of the purposes of monetary policy was actually to improve the labor share of income over the business cycle by tolerating a little bit of inflation in settings where that was accompanied by labor markets getting tightened and working people being in a better position to bargain for better wages. That's a possibility. That's a political choice in monetary management. But we've been living now for quite some time in a policy consensus and in a public discourse consensus that equates monetary management with a set of measures that ultimately seek to maintain, quote unquote, wage discipline. And these days, you often hear central bankers come out and say it very clearly. Listen, what we're really worried about is whether the rate of wage increases is sustainable. And really, when you think about the history of economics and the history of capitalism, and you go all the way back to Adam Smith and how he sought to legitimize capitalism to the world in its early period by saying that it would elevate living standards across the board, it's quite a road from that to a place where responsible economic policymakers openly muse about the need to curb the rate at which people are increasing their purchasing power as a basic tool of economic management. There's something very telling in that journey. The point I'm trying to make is that there are different objectives that can be pursued with the management of monetary systems, and those reflect political choices and social struggle. Now, the political choices are not constrained. There are economics and economic considerations that limit what you can and cannot do. And before I say a few things about in general about what working people in the trade union movement can do, and also in Britain what they can do or could consider doing in the current setting, I just wanted to say a couple of things that I'll be happy to expand on that have to do with economics, right? The things that limit our capacity to pursue objectives through macroeconomic policy involve things like the living standards that people aspire to, our level of labor productivity, what is our collective capacity to produce the things that we need, what are the rates of return that investors are expecting on their investment. And that immediately takes us to questions of the openness of the economy, what's happening in the capital account, and whether or not we are existing in an environment where there is an externally set rate of return that investors expect that is being imposed domestically and then constrains our capacity to do things in any given national economy. All of which takes me to the fourth constraint that we ought to be thinking about always. And here in the United States, people don't think about this very much. Fortunately, in Britain, people are aware of this, as they are in a number of developing countries, is that as we think about the policy space open to macroeconomic managers and to polities ultimately, we need to think about the ways our national economy is integrated with the rest of the world. We need to be thinking about what is it that we are successful in exporting, what is it that we are importing, the relationship between them. We need to be thinking about exchange rate and possible exchange rate movement. How competitive are our different industrial sectors in international trade? And what is our ability as the exchange rate moves, particularly when it moves against us, to continue importing the things that we need and things that go into the cost of living of ordinary people, but also go into our capacity to produce things that we may be able to export. All of these things constrain what we can do. So it's not a freebie, but it's certainly more elastic than what the conventional wisdom has us believe. And I'll wrap up getting a little bit more practical as we think about Britain and the cost of living experience crisis in Britain, which has been particularly stark. We need to be thinking about ways to navigate what are likely to be repeated supply side shocks. I think particularly as climate change starts to be felt more strongly, our experience in COVID, our experience post invasion of Ukraine, is going to be replicated in different ways. Obviously, there's always going to be particularities that are important to grapple with. Britain also needs to grapple with external vulnerability and the possibility that exchange rates will move in an unfavorable way, and particularly given the reliance on imports for strategic goods, including wage goods. This is a very, very real concern. And then we need to think about the institutional and environment and social environment that shapes how companies are able to pass on those costs to consumers. With all of that in mind, I wanted to say two things by way of conclusion. The first one is, in a setting when you're facing a supply side driven or initiated inflationary episode, the conventional tool of raising interest rates to try and control the rate at which prices are increasing is particularly perverse. because it seeks to impose ultimately on the labor market and on the level of employment and on working people's capacity to bargain for better wages. It asks that to suffer to re-equilibrate the economy in response to something that happened on the supply side. We've understood this, by the way, economically since 1802 and Henry Thornton, when he was writing about how do we respond to external shocks and how we need to be thinking about the health of our productive capacity as we respond to shocks. But then there's a number of other unorthodox measures that I think are important to consider and try to change the conversation politically out there about what are the tools at our disposal as we try to navigate these difficult supply shocks with some measures of price stability. So for example, and this is going to sound counterintuitive to some people, but if in long-term bargaining over wages, the idea of automatic inflation adjustments is something that we go back to when we are negotiating new contracts. We have CPI increase indexing in our contracts. That raises the stakes a little bit as policymakers are thinking about how to respond to an inflationary episode. To the extent that the trade union movement and working people can embed automatic increases in response to price increases, the more strongly we are signaling that any inflationary episode could get out of hand, can actually turn permanent. And if we have that strength to do that contractually, we are sending a signal that will make it more enticing for authorities to pursue different sets of policies when they think about controlling prices. And in that connection, I want to bring this point up about public services and kind of the potential unsung hero in a pro-working class and pro-stability approach to how we think about the evolution of prices in a broader way. Because you see, if you have a bigger share of the things that people need provided publicly, you are exposing them less to these potential disruptions that would, one, harm them, but also impel them to bargain for higher wages. So if we can kind of socialize the idea that things like rent control are actually inflation busting, because it is, not only in terms of the inflation that individual tenants experience, but also in the knock-on effects in terms of their wage demands. The same goes for public housing. Again, these are options that shield ordinary working people from the effects of price increases and can serve to stem or reduce the possibility of wage price upward spirals. And then there are all the other things that are bearing very strongly on the budgets of ordinary people, things like childcare, things like groceries and energy prices. And on that account, I'll go back to the co-op as I conclude, because to the extent that the vulnerability of ordinary people is disproportionately to increases in prices for things that they have to consume, things that economists call low elasticity of demand goods. So we're talking here about food and energy, right? It is really time that we start thinking about ways, more creative ways in which government and other forms of organization of enterprise can actually discipline the market by offering the goods in question in a more economical way. In other words, to have a generalization of co-op-based supermarkets or public supermarkets that are run on a different basis and impose a benchmark that helps regulate what the private sector does. Ditto for power and other goods that people need. That's basically what I wanted to throw out there and kind of capture it or try to sum it up briefly with something that's a little bit catchy. If we can make it so that people understand that social policy can be understood as monetary policy, we will have broadened the scopes of debate and actually move towards a more grown-up discussion about how do we navigate these difficult supply shocks when we are organizing our economies on the basis of markets. Thank you.
Inflation is, in a sense, a symptom of real underlying contradictions of capitalism. As Paulo said, it's everywhere a class phenomena, and the interplay of class conflict with the rocky dynamics of capital accumulation are critical here. And so the stories which we tell about the triggers and drivers of inflation and the policies adopted to tackle inflation both reflect these underlying contradictions. So what is at stake in the policies adopted by the state to sustain profitability or stability when the engines of accumulation slow down? Are competing claims over distribution. There is, as Paulo laid out, no neutral approach. But beyond that, given the complexity of the phenomena, the different forms at stake, we also have to come to grips with the specific structural roots of the current inflation. The particular institutional context matters. Now, the issue is not simply that of a general acceleration of price rise, 3% in US, 3.8% in UK. These average trends mask underlying patterns. Concretely, the sharper rise of food and energy prices are the main drivers of inflation today across the globe. And food and energy constitutes the biggest chunk of the budget of low-income working families, so the rise in prices hits harder. It's harder to cut down. On top of that, the rising costs of housing, healthcare, education, transport, childcare, all have a disproportionate impact on these families. And given the squeeze on working class families, the actual growth in consumer spending since 22, at least has been propelled by high income consumers, those whose incomes have been buoyed by the stock market that keeps setting records. In the US, 10% of the households now account for about half of spending. So the first point, inflation at the current moment is an acute cost of living crisis. That's the form. And the burden of rising inflation is overwhelmingly borne by working class families, especially those at the lower income rungs, who are navigating a labor market that is losing momentum. Now, if you compare it to the stagflation of 70s, everyone keeps bringing that up in the discussion. That unfolded in the post-war period, what's been called the Golden Age, when union organizing kept wages growing in pace with rising productivity. Inequality actually declined. And the story told about this inflationary episode is that the growing workers' demands and their resistance to relentless ratcheting up of productivity precipitated higher prices as corporations sought to protect their profit margins. They were simply responding to this pressure. This is the dreaded wage price spiral that haunts the discussion. The scourge of inflation was finally banished by engineering a severe recession to exacerbate unemployment with a sharp hike in interest rates starting with the US, smashing unions, undermining the bargaining power of workers. And this led to what's been kind of sometimes called the Great Moderation, this Goldilocks economy, which is where inflation is low and unemployment is low. But this rested on squeezing real wages. Now, this story is really difficult to sustain today. The success of the capitalist backlash set the stage for a neoliberal low-interest regime. This regime fueled inequality. It further consolidated the corporate power and the growing dominance of finance. So global corporations forged a global division of labor by controlling and coordinating global supply chains, global production networks, which fragmented the working class while creating a large global pool of surplus labor. So you had this global race to the bottom, which kept a lid on costs and wages. Inflation was in check, but asset prices were unleashed. So the recent inflationary resurgence of inflation pressures after the pandemic, in contrast to the 70s, comes against a backdrop of decades of growing polarization, concentration of wealth, declining share of labor in national income, and steady erosion of workers' bargaining power. There is no wage spiral at play. So much so that central banks have been commenting on the anomaly of relatively stagnant wage growth despite rapid employment growth in the run-up to the pandemic. The trade-off between unemployment and inflation, that was the centerpiece of policy discussions, it appears, is actually shaped by the structural context and balance of class forces. Whether there is a trade-off, whether it is sharp, whether it is flat, actually depends on the socio-political context. So when the economies began to reopen in the pandemic, after the initial lockdown, there was an intense competition for workers. The uptick of worker organizing led to some wage growth in the US, for example, and in particular in low-wage sectors, service sectors where the post-pandemic shortages were most acute. But this was short-lived. More recent data for the US shows a slowdown in wage growth for the lowest paid quartile of workers at the bottom 25%. I mean, these are people who'll be earning around $800 a week. This, from a peak of 7.5% at kind of end of 22, it falls to about 3.7%. So after a period when the wage growth at the lowest levels had actually begun rising, it has again begun to sharply fall. Labor participation rates have not yet returned to the pre-pandemic level. Long-term unemployment has been edging up. There's a slowdown in hiring in the US in particular. So it's really hard to sustain the story about an overheating labor market being the cause of inflationary pressures. The stock market may be overheated, but the labor market most definitely isn't. So then how do we explain this return the return of inflation? And as Paulo had kind of laid out, supply shocks that drive up costs are a key trigger. So the pandemic disrupted production and supply due to the shutdowns. The breakdown, log jams, and global supply chains exacerbated the problem. And you had this kind of this paradox, this global system which had been built up to respond flexibly to demand, to create zero inventories, to basically use fissured and flexible workforce to create slack in the system. That basically broke down in the face of sharp shocks to supply. But I mean, this when we think about the pandemic shock, one should also remember that the pandemic seized a capitalist engine that was already creaking. There had been a long spell of lagging productivity, slowdown in investment growth, what's been called secular stagnation. And there were major weaknesses in the supply side that were already present. Now, compounding these supply side pressures and the pandemic shock, we have on one hand, geopolitical tensions, war, occupation, all of that. And on the other, the cumulative impacts of climate change. I mean, again, this has been stressed before, and I think we cannot overstress the importance of these two factors in today's world. You have this escalation of disastrous fires, floods, storms that are affecting not just livelihoods and also production. To add to the fire of fueling cost pressures, we now have the tariff wars. So we have a kind of these overlapping emergencies, which are creating a higher and even more volatile benchmark of costs. This is the new normal. And this is playing out in a world where large global corporate behemoths exercise disproportionate control over a globally dispersed production network. So rising costs are the trigger, supply shocks. But in this context of this really concentrated corporate structures, the ability of corporations to seize the opportunity opened up by these shocks and hike up profit margins is a critical mechanism that transmits and perpetuates the inflationary spiral and keeps profit margins high. So the consolidation and concentration of corporate power globally, which has been taking place over the past decades, which continue to accelerate after the pandemic, and the widespread uncertainty triggered by supply chain disruptions and other supply shocks, these which provide cover, these have become the basis for persistent spikes in profit margins. This chaos, uncertainty we live in is very fertile ground for price gouging. And we see it in sectors like retail, tech, energy in particular. And this is what's been called the seller's inflation. Now, in the US, profit margins spiked. Profit as a share of income rose from the start of pandemic when it was 12% to about 16% now. So there has been this redistribution happening. So if there is a current cost of living crisis, it's also being aggravated by this massive redistribution away from working families. And so we have a supply shock and you have this transmission channel. We don't just have one supply shock, we have a new normal of uncertainty and continual price. I mean, this baseline of volatile prices and volatile kind of markets. So what would progressive working class strategy look like in this context? The knee-jerk policy response, which is to raise interest rates, again, as has already been explained, brings about a recession that will only aggravate the cost of living crisis. It would ratchet up the war on the working class. And this war is evident in the US today in the budget proposals of the One Big Beautiful Act, the attacks on food stamps, while the top 1% kind of rakes in millions during the federal shutdown. But it's really important that we don't let this discourse hold sway and we don't cede ground and let inflation hawks usurp the agenda. There are other paths. Now, first, if we want to stabilize prices, there are mandatory price controls, which is an anathema to policy pundits. It's one tool which can curb profit margins. But you can have buffer stock policies for food, other essentials, which can be released in order to kind of stabilize the market and consumption. But apart from stabilizing prices, we could have straight redistribution to counter the impact of the cost of living crisis and the tremendous redistribution towards profits and the top 1% that is taking place. A windfall tax on profiteers. We could have subsidies, for example, for health insurance. We need to extend them. Income support measures such as cash transfers, tax deductions. I mean, there's a whole range of policies which would redistribute and ameliorate the impact. But even more broadly and even more ambitious, the strategy should not be restricted to struggle over wages or price setting. And the moment needs to be seized to build a wider support for broader political and institutional changes. Now, I mean, inflation is a symptom of deeper contradictions and conflict. These need to be addressed. To take an example, again, something which Paulo talked about, I mean, housing, healthcare, education, transport. These are the key elements in household budgets. And they're key elements to the cost of living crisis, to why it's pinching so hard. So rent freezes, caps on drug prices and tuition, things like these are a start. But we must also demand investment in public housing, public health options, public education, and the expansion of social provision. Decommodify essentials, make them available publicly as a way to, address the cost of living crisis. Given the role of concentration in corporate power, there's also an urgent need to ramp up the antitrust arsenal, add teeth to regulation that curb corporate power, because this is also at the heart of the structural contradictions which underlie the present moment. We are in a moment of flux, of extreme uncertainty, cost pressures from geopolitical tensions, climate disasters. They're here for the long haul. And in this context, one has to think longer, and nothing less than a larger overhaul of the productive structure, more public social control and coordination of critical investments in housing, health, etc., and even climate infrastructure will actually address these growing contradictions. And if one thing is really crystal clear from Mamdani's remarkable campaign and electoral victory is that mobilization is possible. The time has come. Thank you.
Thank you so much, Paulo and Ramaa, for this excellent discussion that raises so many questions that we hope to have the time to continue discussing together. If you've enjoyed the presentations, please follow us live. We have a whole series that is coming up this year at the link below. And share SAPE, a series for advanced political economy, again in collaboration between Free, SOAS, and the New School for Social Research. Thanks for being with us.